Hi, my name is Josh Mahoney, Chief Market Analyst at Scope Markets. This Friday, the 14th of June, we see the Bank of Japan coming forward with their latest monetary policy decision. By and large, people have grown accustomed to the BoJ doing absolutely nothing over recent years while other central banks raise rates. But recently that has changed. Of course, we did see the move out of that negative interest rate environment, and there's big question marks about whether they will go further. Of course, we have seen them try to intervene with a view to trying to prop up the value of the yen. To some extent, they've had some success. To other extent, they haven't, and it's been a very costly exercise. But certainly with this meeting in view, there's question marks about whether they're going to take a different tact, and that would be the potential for quantitative tightening, a potential trimming of the amount of JGBs that they are essentially redeeming each month. And that could lead us on a pathway to higher interest rates down the line. So do we see a shift from the BoJ? And does this mark the beginning of a recovery for the Japanese yen? Does it mark underperformance for the Nikkei? There's some big question marks here, but certainly this meeting is going to be a real one to follow for traders. So let's get into it. First and foremost, here's an image from ING and the Bank of Japan. Essentially, it's highlighting the intervention that we've seen over the years from the Bank of Japan, essentially trying to stabilize their currency. More notably, they have recently been trying to essentially prop up the value of the yen. We've seen two significant interventions, and a lot of the time what we see is initial sort of flashes towards the downside for, let's say, dollar yen, so some strengthening for the yen. And then we start to see it gradually regaining ground and moving back to that level that we had seen previously. We had it at 155, we had it at 160. And we're currently on that trajectory back up into those areas where we could see them potentially intervene once again. In terms of the outlook for inflation, now this is one of the key things to note, is that Japan has struggled to push inflation to any sort of decent levels for decades. And the problem here is that people don't necessarily expect to see higher prices, so people don't demand higher wages. And so the economy as a whole becomes stagnant. We have prices that remain the same 10 years later, and so we see wages that remain the same 10 years later, and you don't see that development. It means that compared to other nations, what might have been a very prosperous country, now all of a sudden, if you're a Japanese person going on holiday to, say, America, things are deemed to be pretty expensive. So there's an idea that essentially this current inflation boom that we've seen around the world, it's a problem elsewhere in the world, but this could be the opportunity for the Bank of Japan to finally kickstart the Japanese economy and kickstart expectations around wages. And we've seen that recently. We've seen an uptick in terms of wages. Now, I've got 3 lines on this rather than 2, but this is just me trying to highlight something that is worth noting if you're looking at Japanese data, and that is the fact that if you look at the Tokyo CPI and the Japanese nationwide CPI, they track each other very closely. But as you can see here with the green line, it is in advance of the purple line. So this highlights that if you're looking for the latest Japanese inflation data, the Tokyo number is the one to look at. It comes out before that nationwide figure and gives you a good idea of where that nationwide figure might move. But it has been moving lower back towards that 2% area. But recently we've seen a surge in terms of wages up above that 2% threshold. And that's what the Bank of Japan needed before they can start to take action and try to prop up the currency in a different way, i.e. the likes of monetary tightening or higher interest rates. And so now we have seen that spike in terms of wages. And, you know, I guess you could say that there's an argument that they need to wait to see that wages are going to remain elevated. But things are playing out pretty well. Inflation back down towards that 2% area, wages moving up above it. And so there's a question mark as to whether they're going to start to take action. Now, they could raise interest rates, but that would have a significant detrimental impact on some of the debts that the government has, massive debts that they have to, of course, service. And when they roll that over and issue more JGBs or Japanese government bonds, then that's going to be increasingly expensive as interest rates go higher. So instead, it looks like they could start to ease back on the amount of JGBs they're buying per month. Currently 6 trillion Yeah, so 6 trillion currently being bought on when they're redeemed on a monthly basis. The idea is that we could see them this time around shift it to 3 trillion. And so that easing back, that sort of pulling back in terms of the amount of liquidity they're putting into market has a number of different impacts. One of those could be argued that there, less liquidity within the market, less potential spending from the government could be detrimental for the Japanese economy. It could be detrimental for Japanese stocks. We've grown quite accustomed to the government issuing JGBs, the Bank of Japan pretty much buying most of them, and everything, ticks along very nicely. It provides that upwind in terms of inflation pressures because we have a continued push in terms of liquidity coming into the market. Well, we could start to see that ease off, and so that could have some significant impacts. In terms of the expectation for the BoJ interest rates going forward, as we can see here, we're expecting to see the rate hike come in July. So that's not too far away from where we are at the moment. I mean, that's essentially 2/3 to 1/3 expectation for a hike in July. But if you look further out, September, markets very confident we will see a rate hike by then. Just 17% chance that we remain as we are at the moment. Then by year end, markets are expecting us to have moved from where we are now, 0.1, up to around about 0.4%. They think there's essentially coin toss between 0.3 and 0.4. So we're expecting to see tightening from the Bank of Japan. And so this meeting could provide the precursor to that as they start to trim the amount of JGBs that they're buying each month. Now, there's a caveat to that because, of course, when you see expectations, it means that they can also disappoint on the flip side. So worth noting that you're likely to see volatility one way or another, depending on exactly what they've done. Here's the trajectory of the JGBs being held by the Bank of Japan. It shows you exactly what they've been doing as we've seen their YCC essentially trying to control the yield curve and to control yields within the Japanese economy. That, of course, has pushed the holdings into sort of sky-high territory. And there's a question mark of whether they start to pull that back going forward. And you can see exactly the sheer size of what they're holding compared to the likes of the ECB, the likes of the Federal Reserve. So they really stand out from that perspective. There's a possibility that we do start to see some normalization. You can see that we've seen a little bit of that recently. And, you can see a similar kind of thing here as we pull back a bit. But that could become more of a theme now that we've seen inflation and wages above that 2% mark. Notably, like I said, the moves that they had been making in terms of keeping yields under control saw exactly that. You can see the Japanese 10-year on that downward trajectory only recently managed to rally back up to that 1% mark. Of course, that yield curve control now aborted. And what's notable here is that this comes at a time when we're seeing sort of sky-high yields over in the US. You can see 4.5% compared to that 1% yield in Japan. And so what does that mean? Well, think of it this way. If you're in Japan and you're thinking about undertaking some sort of investment that you want low risk investment, but you want a high return, are you going to invest it in a 10-year yield, in a 10-year with a yield in Japan of 1%, or are you going to do it over in the US where we get 4.5%? And that differential means that you do see capital flight. You see people moving their money into other countries, other jurisdictions to be able to gain those higher returns. And so the idea is that as we see the potential for yields to move towards the upside, as YCC is aborted, as we see them pulling back in terms of the amount of JGBs that they're buying and potentially raising interest rates in July, then that raises the Japanese 10-year yield. It raises yields. And essentially, you're going to look for the potential tightening of that gap between the likes of the US and the Japanese yields. Now, the yield differential, as we see here, which is essentially the US 10-year minus the Japanese 10-year, like I said, it was 4.5% versus 1. So as we've got on the right here, 3.5% essentially. And you can see here that it has a close correlation with the value of dollar yen. So like I said, if we've got very strong or high yields in one area and very low yields in the other one, and both of them are relatively safe, remember, both Japan and the US perceived as safe havens, then you're likely to see money flow from one area into the other. It's exactly what we have seen, the US dollar going up, the Japanese yen going down. So the question mark here is, will the actions from the Bank of Japan over the coming months, on Friday, of course, but then also for the rest of the year, as we've seen them potentially raising interest rates, if we see that coming into the fore, Is that going to push up this ratio, or will it drive it towards the downside? Well, we would likely see the value of the Japanese 10-year yield rise, so that would drive this ratio down, but also question marks about what the Federal Reserve are going to do. If we see them cutting interest rates in September and acting in the way that they're going to continue to do so, that would again see this roll over. So two potential ways that we could see that ratio, that relationship, it's not a ratio because it's one minus the other, that relationship between the US and the Japanese 10-year could come down if we see the Japanese raising interest rates, which markets are expecting, and the US cutting interest rates, which is questionable because, as I've gone through a million times now, the US has a problem with inflation, and the Fed is going to have to essentially cut interest rates despite CPI being essentially mid-threes. I don't think we're going to get much movement from that area by the time it hits September, quite frankly. So there's question marks around that, but certainly there's the possibility in market pricing for hikes on one side, cuts from the other side, the potential for a narrowing of the gap between the two in terms of the 10-year yield, and the possibility for this currency pair to roll over and the Japanese yen to find some strength as a result. So here is the relationship between dollar yen and the relationship between the Nikkei and the S&P 500. As we see here, the strength that we see in terms of dollar yen has seen strength in terms of the Nikkei over the S&P 500. Now, it's notable because, of course, the S&P 500 has done incredibly well, led by those tech stocks, but the Nikkei's also done really well. Now, there's a number of reasons for it. If you bear in mind that a weak Japanese yen, as we see in this relationship, would make the products of Japanese businesses more competitive, that means that they can sell abroad. And of course, like we're talking about, as the BoJ continued to buy up more JGBs, they're increasing the liquidity. It's beneficial for the Japanese market. So what happens if we potentially see the likes of dollar yen rolling over, as I've alluded to in that previous chart? If we see the BoJ seeing QT and raising interest rates, and we potentially see the Federal Reserve start to cut interest rates. Well, if we see dollar yen rolling over, you're likely to see this relationship also start to show signs of weakness and potential outperformance for the S&P, underperformance for the Nikkei 225 as a result. As we see lower liquidity coming into play, we see that sort of benefit in terms of Japanese domiciled businesses trying to sell abroad because they're selling in a currency that's essentially being devalued, and they're earning abroad, which is increasing as value. So if they're earning in dollars and they're reporting it back in the yen, then it's beneficial for them. So what we're looking at here is the possibility of us to start turning the tide for dollar yen. Whether it comes to fruition remains to be seen. It all comes down to whether the Bank of Japan are essentially going to take that action. Are they going to start to taper the amount of JGBs that they're buying per month? Are they going to lay the groundwork for a potential rate hike in July? Is the Federal Reserve going to cut interest rates in September, despite the fact that inflation is probably going to be mid-threes? A number of different questions here, but certainly it highlights just why this Friday's meeting is so important and could really start to set us on a potentially different trajectory going forward for the yen. So let's look at that. So this is the chart for the Nikkei 225, first and foremost. So from a wider perspective, you can see, look, it's been a great period for this index. You can see gaining, let's say over the last year, we've seen it gaining 20%, but over the last 5 years, up 84%. So, really pushing onwards and upwards. Where are we at the moment? Well, we're back at trendline support, starting to regain ground at the moment. You can see here in terms of sort of near-term resistance, we've got this sort of cluster of resistance here. So we have some resistance to break through, but certainly as things stand, it doesn't necessarily look like this market is rolling over. So bear in mind that when I was talking about the relationship between the Nikkei and the S&P, I'm not talking about the Nikkei. So I'm not saying if the relationship between the Nikkei and the 225 and the S&P rolls over, then you're seeing weakness in terms of the Nikkei. Both could still go up. It's just that the S&P could go up more than the other. But then on the flip side, when markets are selling off, the idea is that you're probably more likely to see the Nikkei suffering more heavy losses compared to the S&P 500. So it's all relative between the two if you do see dollar yen rolling over. But certainly for the time being, it's trying to regain ground once again. Let's just strap dollar yen onto it and see exactly how things shape up if you were going to put the 2 on. So what we can see here more recently is, we do see some jitters within it. I mean, look, you can see close correlation down here between the two. And then more recently, you can see this pullback coming into play. So you can see the recovery here, the pullback, then the rebound. We're seeing this rebound in terms of dollar yen. It's coming exactly the same time as we're seeing it in terms of the Nikkei 225. So that idea that if we see the dollar yen rising is beneficial for Japanese businesses, that kind of does support the idea that, the strength we're seeing at the moment in terms of dollar yen is beneficial for the Nikkei. But if we see dollar yen rolling over, it could be detrimental for the Nikkei 225. In terms of its trajectory, like we said, we're seeing sort of higher highs and higher lows, but the top end is sort of quite questionable. I'd say that this is a rising wedge formation here. And so you're seeing sort of very slight gains on the top end, more dramatic gains on the bottom. But certainly if we do see a breakdown back through your sort of previous swing lows, here's 38534, that could set a potential bearish move into play. For the time being, we are still creating this higher highs, higher lows. If we break through the 39164, it's going to give us greater confidence that we continue to push, and then 39474 would be the next target. But certainly, we don't necessarily know how this BoJ meeting is going to play out, but it does have the basis for potentially coming to the detriment of dollar yen and of the Nikkei 225. So here's dollar yen again. If we switch between the two, there's not huge differences, certainly more notably in recent times. And you can see here this pullback once again coming in towards this sort of trend line support. We didn't necessarily touch it on this occasion. What we did touch is the 76.4 Fibonacci support level. So you can see this higher highs, higher lows, and we have been regaining ground since then. So the trend is your friend until it ends, and that trend has not ended. You can see the uptrend is still in play. We still have higher lows. We're trying to regain ground to get back up to your 160 mark. But like I said, when we get back around those areas, that's when we see the BoJ intervening. So there is likely to be some jitters around this area anyway, because of question marks around the possibility of the Bank of Japan to intervene once again. But on this occasion, it might not just be FX intervention. It might also be the beginning of some new moves in terms of QT as we set up for a potential move towards a July rate hike from the BoJ. So regaining ground from Fibonacci support at the moment. You can see it once again on the hourly time frame. That we've got this support level played out absolutely perfectly. Let's see, there we go. And then we've pulled back into another fib support, into the deep fib, a sharp rally we saw on Friday around that non-farm payrolls. Now we're starting to see a little bit of weakness, but the bullish trend does still play out for the time being. But ultimately, we could start to roll over. And if we do see a breakdown through this support level around about 154.5, that would also take us through trendline support. That could be the basis for a wider rolling over for dollar yen. But it all comes down to exactly what the Bank of Japan opt to do on Friday. If they decide against it and they keep things as is, it's likely we're going to see further upside in terms of dollar yen. But if they do start to set QT in motion, essentially, and they gear up for a potential rate hike in July, I think there's a good chance that we do see some strength for the Japanese yen coming into play. And perhaps question marks emerging around the weakness of the yen at a time when it's one of the most reliable currency pairs to be betting against, essentially, because it's been a long time that we've seen this. This is the monthly time frame. It's a long time that we've seen this as essentially one of the easiest markets within the market, easiest trades within the market, because the yen just keeps going down. Well, what if the BoJ starts to take steps to reverse that? That's why this week's meeting is going to be particularly important. I hope this has been useful. Make sure to follow and subscribe on the channel, and we'll be giving you plenty more content coming up from myself, Josh Mahoney. Have a great day, guys. Thanks.